still makes good sense for a lot of nations, even those that aren't very friendly with us, to use the dollar because accounting systems, conventions. I mean, when I was a trader, if I picked up the phone and I went to buy or sell oil, I wouldn't even have to say dollars. I would say 5 million or 2 million because it was just understood. The dollar is the lingua franca of the global economy.
Hello, everyone. It's Zahra Sethna, host of Collapse Life, the thinking person's guide to civilization and demise. Before we get into today's show, a quick ask. If you value clear, unfiltered takes like this, please hit like and subscribe now. Today, we're very pleased to welcome back Peter C. Earle, Director of Economics and Economic Freedom at the American Institute for Economic Research. It's pretty clear we're going to be talking about economics today. And in fact, I can't think of anyone better than Peter to guide us through some of the recent financial chaos we've been seeing, from the Fed's next move to inflation confusion, trade theater, and what's really going on with jobs numbers. So, Peter, welcome back. Thank you so much for being here.
It's great to be back. Thanks for having me.
That's wonderful. And as we have just said, there's so much to talk about. Maybe let's start with the latest from the Fed. Are we about to see a rate cut? And just to help people understand, what does that even mean? What's the goal here?
Sure. So the Fed sets what are called policy rates. That's basically the short-term cost of borrowing money. They do that through the Fed funds rate and through other tools that they use, open market operations, that sort of thing. Um, right now, the question is whether rates are too high or not. The Fed, of course, raised rates starting in 2022 to sort of to put the lid on inflation. So generally speaking, if the Fed wants to expand economic activity, they lower interest rates, which makes it cheaper to borrow. More people can get their hands on money. If the economy is overheating, they raise rates to make it more costly to borrow money. But in this case, rates have been where they're at for over a year now, and there have been some signs that maybe the Fed should be lowering rates. So the president has made a big show of criticizing the Fed. It's a little out of sorts. I mean, every president, every political administration has sort of tried to muscle the Fed, but never as openly as this one has. Basically, it's like this: the Fed has two mandates, right? One is to make prices stable, a stable price mandate, and they also have a mandate of maximum inflation. But at times, those two come in conflict, and that's what we're seeing right now. Because, you would think that with some bad economic numbers as we've received recently, in particular by bad economic numbers, I mean rising unemployment numbers, the Fed would want to lower rates. However, we've recently seen a resurgence of inflation, and for that, the Fed would want to raise rates. So they're sort of stuck in between the proverbial rock and a hard place. And in this case, the president wants the Fed to emphasize the employment mandate because he wants lower rates. He wants to stimulate more growth. But the Fed also doesn't want inflation to come back because that also has negative effects for the economy. So right now, there's a very obscure market called the market implied policy rate market, and that's taken from some obscure indices, that sort of thing. It's forecasting about an 80% chance, maybe 85% chance that the Fed will lower rates in September at their next meeting. So that's where the market is leaning. That's probably what will happen, but you never know.
And what will that do for just everyday prices and, mom and pop? I know a lot of people are going to be wondering, and you can help make sense of this. Is this going to trigger mortgage rates coming down or help the housing market or the jobs market?
I think it's possible. I mean, a one increment lowering of the interest rate would be 25 basis points, which is a quarter of a point. Not a big deal, really. I mean, it'll change some things. Usually, when we see the Fed lower their rate, the Fed funds rate, we see other rates lower at the same time, but not as much. So, with a 25 basis point, a quarter point cut in the Fed funds rate, you might see mortgage rates come down 12 basis points. That's an eighth of a percentage, something like that. Not a lot. It will take some pressure off in some areas, but I mean, the kind of substantive rate lowering that we would need to see to really affect borrowers right now would be sizable. Trump would definitely like that kind of thing. He's talked about interest rates being 3% lower. That would be a tremendous lowering that we're just not going to see right now.
And if borrowing gets cheaper, couldn't that actually raise prices instead of calming inflation?
Absolutely. Yeah, and that's the risk. The risk is that the Fed responds to, the BLS numbers we saw for July, which I can speak a little bit about, which showed the actual non-farm payrolls number was lower than expected, but the revisions were tremendous. We
Right.
actually saw the creation of, only 12 or 13,000 jobs, where we thought almost over 100,000 were created in those months. And for that reason, there's a suggestion that we should lower rates. However, if we lower rates, we drive prices up, we're impacting the economy in another way. And one of the things we've learned in this last outbreak of inflation, which is the first major one since the 70s, is that we now have a very service-based economy. We don't have this industrial economy that we had 50 years ago. And for that reason, the Fed policies are probably a little less effective. Just doing a thought experiment, we can imagine why it is that lowering interest rates would make it, would help, say, a ball bearing manufacturing firm, or a car builder, right? Because that's lower cost to procure materials and lower, rates of financing and all that. But if you think of, like, just to use a silly example, like a dog walking company, or,
Mhm.
or a coffee shop, right? Lower rates don't affect them as immediately. And we have a service-based economy right now, so the Fed's ability to impact inflation is lower. So they're going to be really careful in the decisions they make regarding anything they do. In this case, regarding the employment uh, scene that we have right now.
Sure. The thing that is impacting these small businesses, though, is the tariffs, and we have yet to see, I think, the full effect of the tariffs. Is that
Right.
correct?
Yeah, so what we saw on August 2nd, on Liberation Day, which some of my colleagues now call Obliteration Day,
Was
because
that
we're in
April? Yes.
April 2nd. Yeah,
Right.
yeah. We had the second market crash in 5 years, which is always funny for me to think, because I worked on Wall Street for 21 years, never saw a market crash. So those are big drops. But since I've been an economist, I've seen two, like, actual definitional market crashes. But those rates that we saw on Liberation Day, which were called reciprocal tariffs. They weren't really reciprocal tariffs. I can explain why if you'd want, but they were astronomical. We saw tariffs of 30, 40, 50% on various nations. And, at that time, if I was asked, I would have said, yeah, that will definitely cause a recession. Now, those were backed off of. We've seen tariffs put in place on various goods. They've been put on, they've been taken off. And for that reason, we haven't really seen the full effect yet. What we are seeing, though, is that businesses are withdrawing from making certain investments, like expanding their plant and capacity, starting new product lines, hiring more, because they're not sure what their prices are going to be. If you don't know what your input prices are going to be, it's very hard to make those sorts of decisions.
Mhm.
One of the other reasons why we haven't seen any major effect yet, in addition to the fact that tariffs have been put on and taken off, and we're in the midst, by the way, of our third 90-day suspension of tariffs on China, is that a lot of firms, when they saw those tariff amounts, they went ahead and they did huge pre-positioning in inventory. So
Right.
they bought up a lot of inventory at the pre-tariff prices, and what they're doing right now is they're slowly drawing off of that inventory, and they're doing things like they're eating part of the tariff amounts, the lower tariffs that we do have in place, that sort of thing. So I think if there's one thing I would point at, it's Walmart's earnings. Walmart had earnings last week, and they basically show that their revenues rose, but their profits were lower. So what they're doing is basically they're making the same amount of money, but they're basically um, using some cost sharing by not. They're basically trying to eat part of the tariff cost right now while they can, and drawing off of those inventories. But I think for a lot of firms, when those inventories are depleted, we'll see some of those tariff effects. Now, the tariff rate through the beginning of this administration was about 2 or 3%. The current average tariff rate is about 9%, but when they're fully rolled out, the estimate is that they'll be somewhere between 15 and 20%. That's a huge leap from
Right.
what we saw previously. It's a huge leap even from what the Trump administration did in their first term. So I think it's unlikely that we'll see no effect whatsoever when they're finally put on full force.
Hmm.
Yeah,
Now, just going back, tariffs were sold to the American people as being pro worker and pro American. So far, as you've already kind of described, a lot of big businesses are already pre-positioning and getting ready to
right.
prepare for this. Small businesses are sort of panicking and feeling
Sure.
anxious about this. And we haven't yet seen the full effect. I think this is going to take a few months to sort of actually
Yep.
get implemented, and we'll start feeling it. But um, philosophically, will they actually help, or will they just make life more expensive for Americans?
Well, the thing is that there's this idea that that jobs were stolen from America, manufacturing industrial jobs were stolen by other countries, but it's simply not the case. A few things have happened, right? One is that we became a more service-oriented economy. One is that labor prices rose to places where other nations could do those things cheaper. And I mean, there's sort of a trade-off here, right? I mean, when we get goods for cheaper from overseas, it makes it more possible. It makes it easier for households to survive in what is perpetually rising inflation.
Mm-hmm.
Even at the 2% rate, which is the Fed's target, we have rising prices over time. Um, it's more our industrial production, America's industrial production, has risen year over year, and that's partially because one of the reasons why we've lost manufacturing jobs is not that they've been stolen by, I mean, stolen is a silly word anyway, but not that they've been taken over by countries overseas, but also we've just become more automated. A lot of work that used to be done by hand is done by machines, and also, I mean, anybody who points the finger at China. I mean, one of the things we've seen in China over the last few years, that Chinese manufacturing jobs are decreasing, and they're going to Vietnam and other places. And eventually those jobs, when they get too expensive there because of a rising middle class, will go to other places, maybe South America, maybe Africa, who knows. But this is the process that's taking place all over the world. The same trajectory we see with manufacturing jobs in the US took place in agriculture in the latter half of the 19th and early half of the 20th century, and in other countries like England, Japan, Germany, many other countries. So this is not something that's isolated with the US, and there's a lot of explanations for it. Now, the question is, would it be would we view as a success getting a bunch of manufacturing jobs back in say Ohio and places like that, Indiana, if it drove costs up? I think a lot of Americans, they like the idea, but they don't like the idea of prices going higher. So,
Right.
that's the basic argument is that. Would it be better to have those jobs back? I don't think it would be. I mean, we haven't seen we've seen lower unemployment in the last couple of decades than we saw even when we had a manufacturing economy. It's changed the structure of many places, economically, some states, and there's ways of dealing with that. But another factor is that if you want me to just get into the whole thing about trade deficits, right? I mean, the U.S. has run trade deficits for many years, which means we buy more from other countries than we sell to them. But that's not, I mean, that shouldn't be looked at as necessarily a loss. What it means is that, a lot of countries want to access our massive, 18 to $20 trillion consumer economy.
Mm-hmm.
And also that US dollars and treasuries are still viewed, perhaps unjustly in light of deficits and debt, but they're still viewed as sort of the gold standard in global finance. And, to use a personal example, I personally have a huge trade deficit with my local supermarket. I've bought more from them than I've ever sold to them. And I don't view it as a personal failure or a loss that they won't buy an economic paper from me or a book from me, because that's just not how it works. The way to look at it is the U.S. has a trade deficit, but we have a tremendous account surplus in goods and services. And that's the way to look at it.
You mentioned our debt, and we've seen recently signs that the US is having more trouble selling its treasury bonds. There are
Yep.
fewer buyers. They've needed to offer higher yields to attract the
Right.
buyers.
Yep.
Talk a little bit about what's going on in the bond market, and where does that trouble lead to if it continues?
Well, there's been a few things. I mean, first of all, uh, the U.S. has sold a lot of treasuries, and treasuries are goods like any other, and the demand curve slopes downward. I can only eat so much ice cream, and other countries can only, buy so many treasuries. After a while, they get kind of full, right? And there's been an avalanche of treasuries produced to finance growing deficits and debt. And the other thing is that there's an argument that the interest rate, the yield on treasuries, doesn't really reflect the risk. We're now $37 trillion in debt, and the argument is that maybe the yield should be higher. If that were the case, it would mean that the U.S. debt service would rise. It's already right now at yields between 4.5% to 5% on most Treasury issues. That's about $1.2 trillion a year of debt service. Now, I would urge anybody listening to think about this, right? $1.2 trillion a year goes out the door only to satisfy our debt, not used for infrastructure, not used to lower your taxes or whatever else. I mean, that's a real shame. in my mind. And
Mhm.
so for that reason, there's an argument that maybe treasuries don't really reflect the risk of debt and deficits that we have at 37 trillion in debt, and that some buyers are starting to back away. And there's another factor too, and that is this goes towards de-dollarization. When the Biden administration kicked Russian banks out of SWIFT, or pressured SWIFT, which is an international money, it's kind of like PayPal internationally. It's a financial network internationally that goes to settle huge commodity and other trades. Anyway,
Mhm.
when the Biden administration kicked Russian banks out of SWIFT, it suddenly informed a lot of our adversaries and allies that that using the dollar could basically present some risks. And one of the reasons why there's such demand for treasury securities is because the global users of dollars want something to do with their dollars while they're waiting to use them. They want to get some interest on them, so they buy treasury bills and things like that. For that reason, if the use of the dollar declines, and it has a little bit, not much, there will be less demand for treasury. So there's that going on as well. A lot of interesting things being talked about right now, like this Mar-a-Lago plan to create century bonds and all that. Most of which I think is just sort of like a shell game, but that's another topic.
Talk about the big beautiful bill and how that's going to affect our current debt and the servicing of it.
So the big beautiful bill, it promises a lot of tax cuts paired with lots of new spending on infrastructure, that sort of thing. And it may have some short-term stimulus plans, but it actually increases the deficit a lot.
Mhm.
That's the one thing, is that this is not going to cut debt; it's going to expand to it. And our already unsustainable debt levels are going to be expanded by this. This reset of U.S. industrial competitiveness that it touts. This ties back to my comments about industrialization, or the purported deindustrialization of America.
Mhm.
I don't see going back to furniture building plants in the Midwest and that sort of thing as a step forward. We'd be better on, if we're going to promote growth, it would be better to do something like promote AI or something like that. But fiscal profligacy is not prosperity. And this bill, like many others, is going to shift resources from private to political allocations. And the other thing is that when we do this massive borrowing, such as we're doing right now, we're crowding out private entities. The government can essentially print money and float debt costlessly, which makes it difficult for private businesses to do things. But the one big beautiful bill, it's definitely big. I'm not sure how beautiful it is, but it's looked at as a great victory by people who support the current administration, and in particular, its fiscal goals. So that's what we're left with.
Right. I want to go back to inflation because I think that ties in, where if the government is going to be spending more, the official line is that inflation is actually cooling, but people don't really feel that. It feels like everything is costing more. So what's the disconnect, and is there any way of actually rationalizing that?
There are a couple of disconnects there, I guess. I mean, the one is that even though we're seeing disinflation, which is a lowering of the rate of inflation, prices are still rising. I mean, the way to think about inflation is like acceleration, right? Like if I'm driving up a hill, I can drive up slowly or more quickly, but I'm still going uphill. And so, we 3 summers ago, in the summer of 2022, we had prices rising at 9% year over year. They're now rising between 2.5% and 3% year over year, still rising, just not as quickly. And the other thing is that inflation indices only capture certain things, right? I mean, every inflation index, whether it's the PCE or the CPI or the PPI, they cover thousands and thousands of goods and services that are weighted differently. Most households buy 10 to 20 different things, different categories. And for that reason, those indices may be telling a story that's not really true for the individual in the household.
Mhm.
Um, with inflation right now, the Fed has basically tried to raise rates. It's held rates high in an effort to bring inflation down, which it has somewhat. But the monetary source of inflation is one part of it. There is a portion of it that's tied to government spending, and we're getting a lot of that now. So there's that. And again, the Fed's tools don't work as well in a service-based, highly financialized economy as they do in a goods-backed economy. So there's a lot of factors for which, when the Fed says, or when we get numbers from BLS that say, yeah, inflation is 2.5%, it actually feels, and probably is from the consumer's perspective, a lot higher.
There's a lot of ways too that businesses kind of shield the inflation from us, from
Yeah.
shrinkflation to hidden
Yep.
cost and junk
Mhm.
fees and things like that. So,
Right.
are we even measuring inflation in an accurate way anymore?
No, I mean, I could speak for hours on measurement problems in economics, but
Hmm.
certainly the issue of shrinkflation is one, and I never really understand when people come down on companies for that. Like they're doing their best. If you want them to act unprofitably, they're going to go out of business. But I mean, so we're definitely seeing, I see it here when I do the shopping. I mean, you see weird sizes for goods I've never seen before, but ultimately less of the product inside. Again, a lot of the inflation is hidden by different forms of economic measurement, which don't capture those changes in sizes. Um, Another thing that happens, and this also happens with tariffs, by the way, is that you don't have to necessarily see prices rise. You can see goods just disappear from shelves. Companies can produce less, so they might put, instead of your grocer being fully stocked with certain goods and services at certain times of the year, they may carry less of them. So there's lots of ways that the rising prices can be fought by or can be combated by producers, many of which, in addition to rising prices, are not great for consumers. It's not good for our consumption health.
Hmm. I mean, and ultimately, too, people need to buy the things that they need. So whatever the price is, they're just going to pay it. So
Yeah,
is sticker shock just the new normal for us?
it may be. I mean, I'm not sure if the Fed decides to lower rates because they view employment as and labor market as the greater risk right now. I mean, we may see years before we get back to that 2% target. I mean, that's quite possible.
Mhm.
Another factor is that you know wage growth has stagnated a little bit, so people's wage growth is not keeping up with the rate of inflation. That's a bigger factor too. That's the other side of the equation, if you will, of
Mhm.
consumption. And so for that reason, yeah, I mean, we may already be seeing, the start of an era where we have individuals choosing to make consumption decisions and cutting elsewhere. I mean, discretionary purchases, things like restaurant spending, things like holiday spending, all of that sort of thing is already being cut. We're seeing a little bit of that right now. I mean, it seems like every day we found out that Bahama Breeze, right? I mean, they're cutting back locations. I spoke about restaurant devastation last year, and it's still going on to some extent this year. We're seeing it a lot, and that has a lot to do with the fact that consumers are having to cut back spending on discretionary areas and focus on the things they really need: food, fuel, the rent, all that sort of thing.
Right. One
Yeah,
of the things when you came on last and we talked about the restaurant apocalypse, one of the things that came up as well was a really interesting idea of personalized pricing,
yeah,
and I'm wondering, want to get your take on that
yeah,
because Delta Airlines just made a big announcement, and this is
yeah.
now happening. But is this a way as well where perhaps we won't even know if prices are rising because we'll only be seeing our own version of pricing?
Yeah, I think so. When Wendy's announced it last week, last year rather, right? Last year about this time, by the way, I remember I spoke with a friend of mine, and he said, if they do that, they're dead to me. I'll never shop at Wendy's again. But I mean that kind of a development of this sort of dynamic pricing is very much a product of inflation, and it means trying to scoop out higher profit margins where companies can, based upon the behavior of consumers. I think the difference, and by the way, airlines are already doing this. I mean, whenever I look for an airline ticket, I always use a VPN because I don't want them to know it's me
Yeah.
doing this and then to get information about me. I think the difference now, so my point is that firms are already doing that, but I think what's different now is that AI is coming into it.
Mm.
So I think they're applying. I think Delta is not just doing what all airlines do, but now they're applying AI. And basically, proponents of this argue that it maximizes efficiency, it matches the willingness to pay with things like the amount of seats and all that sort of thing, and maybe it fills planes more efficiently and more consistently, which is good for fuel prices and all that sort of thing. But it also, I mean, as we saw with Wendy's, it erodes consumer trust and transparency. I think it would be a lot easier for an airline company to do this than for Wendy's, because with an airline company, I'm usually doing this on my own in my office or on my phone. Whereas at Wendy's, you could be standing next to someone and say, "Why did you pay $2 for that and I paid $1.75," or vice
Mhm.
versa, right? So I
Mhm.
mean, I think the transparency issue is what will make it more difficult for a lot of companies to be able to get away with doing this.
But so there's another sneaky way of doing dynamic pricing where it may not be so individual as though, we're both in the grocery store and you're buying eggs and I'm buying eggs, but we have two
Right.
different prices. But there's dynamic pricing where they're
Times of the day.
changing the price during the course of a day, and
Right.
they're getting rid of these paper tags,
Yep.
bringing in
Mhm.
electronic tags, and we're seeing we wrote about this on Collapse Life, and they're already using it in Europe, and prices can change throughout the day. So you don't
Yep.
know what it was priced this morning if you weren't in the store. You just know what they're showing you now, and it could go up or down later. This,
Yep.
I think, is going to make it even harder for us to keep mental track of whether prices are rising or falling.
I think that's already happening in some businesses, and what we would be talking about them is then is the expansion of that to many more realms, like the supermarket. Like, I mean, already, you see like movie theaters will have a different price for an early showing than a late showing or something like that. But I think the what we would see is if inflation becomes entrenched and or tariffs go up substantially enough that they start denting profit margins, we could definitely see an era where this becomes more of the norm and in many more goods and services than we're used to.
What is the role of AI in all of this dynamic pricing scheme?
Well, AI is will make it make the will make the process of determining those prices a lot more finely honed. It'll be, instead of just saying we're going to drop 25% here and there, AI will look for patterns. It'll look for certain days of the week. It'll look for certain customers, what they do, maybe combinations of things that people buy, things like that, maybe certain locations. It will use a lot more variables to more closely define, I mean, basically what it'll be trying to do is finding out what the slope of the demand curve is. So it'll be doing that for different customers and for different times of day, and it will do what would have previously have done sort of by instinct, sort of by guess, a process of a very quantitative process. So it's going to refine the process more over time and with more data.
And it sort of removes then the business owner from the equation,
Yeah,
in a way, doesn't it?
sure. Yeah, I mean, AI is a support tool, right? I mean, where AI is used best, I mean, certainly there's going to be a lot of jobs that are replaced by it. But what I find is that where AI is best is when I have an idea and I sketch it out and I say, you know, what am I missing? And then, I say, what other papers were written of like this? And AI will spit out a few papers and I'll go and look at those, right? I mean, it makes the process more efficient, but it doesn't, in many processes or in many jobs or undertakings, it won't replace people. It just makes us better. So, I mean, I think that's the role that it'll play, that'll play. And, certainly an entrepreneur can say, or a business owner can say, hey, AI, or hey, AI developer, more accurately, can you design something that will take all this data and make it easier for me to figure out what people will pay at different times of the day. So, that's the entrepreneur using AI, but not being completely replaced by it.
I mean, so some would argue that there are wide swaths of the economy being replaced by AI, and
Right,
even they're just tools for people to use. As things become more efficient,
right.
it requires fewer humans to do a task if you have an AI assistant who can move at the speed of lightning. So let's apply that and kind of move over to talk about these jobs numbers where,
Yeah,
we are seeing more unemployment, fewer jobs being added to the economy. This was something that hit the headlines very strongly very recently, where
yeah,
the commissioner of the Bureau of Labor Statistics put out numbers. They were
yeah,
revised, and hours later, that person was dismissed by the president. Talk a little bit about that, and also you dug into those numbers a little.
yeah.
So tell us about what you found.
Sure. So, I mean, the first thing I have to say is that, you know, numbers convey expertise and they convey precision, but economic numbers are not numbers that are arrived at by processes like you would see in engineering or physics. So these numbers are very rough. There's a trade-off between the periodicity of numbers and their exactness, right? So if you wanted a really great employment number, you might want to switch to doing it quarterly or every 6 months. But then what you do is you get numbers that are more accurate at that point, but there's a 6 month gap,
Mhm.
so the numbers are less connected. You could also have employment numbers that are generated every day, and those numbers would rapidly approach randomness, but you'd be getting numbers every day. So the exactness or the accuracy and precision versus the timing of the numbers is a major issue. And monthly numbers are what I guess the financial markets and business world have settled on for inflation and for employment numbers and that sort of thing. But I mean, they're not perfect and they require revisions every so often. I mean, one of the things I pointed out when I looked into the massive revisions, which were really, really, I mean, we've only had numbers that rare about 8 times in the last 20 years. One thing I found out is that the response rate to one of the BLS polls is about 41%. Now, you can imagine if you're only getting 41% responses to certain polls, that you're selecting for a certain kind of individual, whether that's a kind of person that works certain hours, they have certain finances, right? That sort of thing. So the numbers can very easily be leaned on in a way that's not justified. It's economics is a soft science. It's more like psychology or anthropology than it is like physics or engineering, whatever economists ourselves might want. But I don't think the revisions of BLS that we saw in the July number going back, the 258,000 job revision, which is colossal. I don't think that had much to do with AI at all. I think it had more to do with the fact that our means of gathering data are more flawed these days, and also we have a lot of entrepreneurs that are responding to tariffs. A lot of people wanted to add to the headcount. If you look at the business optimism numbers in November and December of last year after the election, they were skyrocketing. And those have rapidly reversed because a lot of people who run businesses, a lot of people who manage businesses, don't find the kind of certainty they would want to expand their operations to add, as I mentioned before, expand operations, add to the headcount, that sort of thing. In terms of the BLS number, what we find is that you have really big BLS numbers when the economy is in change. So all of the major numbers that I've seen, there are about 6 or 7 of them that are to anybody who's statistically inclined greater than 2 standard deviations. They've all come at periods like 2008, 2020, early 2021, and now this one, suggesting that there's a lot going on under the surface of the economy right now that may take a while to play out. Maybe it's reversible. Who knows? But there's definitely things going on.
So, if a revision this big is more of a feature than a bug, or not as rare as we might think, then
Right.
what is the danger if politicians or markets overreact to the numbers as they come out?
Yeah. So, I mean, first of all, the numbers provide a narrative. If they're strong, of course, political entities are going to say, see what we're doing, see how great this is working. And if they're not, they're going to say, well, I mean, until recently, they would say that the numbers just aren't accurate. They would ignore them. Now people get fired for them, which is a kind of a new step. There's a new risk for people who run these statistical agencies. But, you know, one thing I looked at when I looked at the BLS revision is that if you are assuming that those employment numbers are distributed normally on a normal distribution, the BLS revision we got last month would be about a 1 in 100 trillion event. Now that's obviously not the case, and when you look at the numbers, they're very heavily tailed. So these numbers do come up, and they're usually, like I said, within 6 to 12 months of a huge change in the economy, up or down. And so that's what I think there is happening. But as for the political ramifications, I mean, firing someone over the numbers is kind of shooting the messenger. And it also means that it's actually quite ironically going to more further politicize those roles because now you've introduced direct political influence where before it was to either ignore them, or to sort of say, well, they don't measure this or that or the intangibles, which is closer to the truth than not. But I think we're in new territory here with the firing of the BLS commissioner.
Absolutely. It changes everything really, because you would think too that the next group of people who take those roles are going to say, well, I better put out numbers that the administration is going to like. Otherwise, I might lose my livelihood. It will make big headlines. This is going to be very humiliating. So it may change, even though it's numbers and you can't really, you can fudge numbers, but if it's data in, data out, but the way you analyze it, the way you massage that data, there's so much potential for weaving a narrative that makes it look however you want it to look, which on the flip side then just erodes public trust even further at a time when institutional trust is probably at record lows.
Right. And so I don't believe, I mean, I would be a fool to sit here and say that political figures and bureaucrats in particular don't respond to incentives, that they don't have their own objectives. But it's not very easy to fudge those numbers completely. I mean, they could delay putting them out, but I don't think the numbers are manipulated in that regard. Now, we could see a process where the methods of gathering data and the methods of disseminating it and the base years and other things like that are changed, but actually just taking the number and changing it right before it's published, not very likely. But the fact is what you said. I think that's exactly right. Is that now there will be suspicion behind there'll be suspicion about numbers that are below target. There will be suspicion about numbers that are hugely above target, which would have been well founded if from the perspective that the numbers are just not science at this point. They're taken by a lot of sort of squishy methods and imperfect methods. But now there's going to be this view that they're politically manipulated, which, I mean, we thought that about the Soviet Union for many years. We know that about China right now, and so it's a kind of sorry state of affairs. And just like in regular life, right? I mean, reputations and credibility takes years and years and years to acquire, but one move like this can immediately sort of drop out the floor. And
Yeah.
so it's going to take a long time before people trust those things again, I think.
Yeah, if at all. And in
Well,
the meantime, what do we do then? Because we're already, working at a disadvantage. Most people walking down the street have very little knowledge about some of the things that you're
right.
talking about. It's a highly specified, very complex system.
Yep.
And so we already don't understand it. We trust people like you to help us, make sense of it. And then
Hmm.
if you're already looking at numbers and not sure whether you can trust them, like it just cascades down
Right.
domestically, but it also makes us look uncredible internationally, doesn't it?
Sure. I mean, you know, the thing is, like I said, the numbers should always be viewed with some degree of skepticism because of the fact that we're using imperfect, methods of gathering the data and all that. But this is a crossing of a Rubicon. This is a very different thing. And one of the things that the fellow that was chosen to replace the former commissioner has said was maybe we should just suspend a monthly number. Well, gosh, I mean, that's not going to do a lot of help to restore credibility. I mean, that's going to make these things even more questionable. And yeah, I mean, for many reasons, the U.S. was viewed as sort of sort of a beacon in terms of our precision in gathering numbers and all that sort of thing. But we're really sort of cutting our own legs out with this sort of activity, and a lot, and it's just in this hyper politicized era. A lot of people, the minute the president said, you can't be that wrong that often. Well, you can. Actually, you can be that wrong very often. And now it's become sort of a mantra among his closest supporters, which is unfortunate because it just means that it's another area of our daily life which has become hyper politicized, which is not good for anyone.
Absolutely. Um, we've already talked a little bit about how our creditors are losing faith in our economic system and our dollar.
Yep.
Um, and as consumers, as Americans, is there a chance that um, people start waking up and actually saying, "Ooh, I'm also losing faith in this dollar and what it might buy me today versus what it might buy me in a week or a month or a year." Will that potentially lead to a rush to go out and buy things before prices might spike? And could it lead to potentially what's called a crack up boom?
So we've seen a few hints of that. I mean, one thing is that the purchase of gold and silver has increased over the last few years. People have become more interested. We see that in prices. We've also, by the way, a big part of the run up in gold prices has had to do with governments. China, Russia, some other countries, the BRICS, buying more gold to sort of hedge away from the dollar. We've also seen, one thing we've seen is that inflation expectations among the public on both the 1 year and the 5 year horizon has increased. I think the last number saw that consumers expect inflation over the next 1 and 5 year period to be over 3%, which doesn't sound like much, but it's high. And whenever people have expectations of higher prices, they begin to act in accordance with that. There's a whole body of economic theory, and there's an economist who passed away recently, Robert Lucas, who got a Nobel Prize for talking about the role of expectations in inflation. And so, we're not seeing a huge amount of that now, but we are seeing more of it than we used to, and it's certainly something that could rise over time. People are starting to think more in terms of hedges. I think they're starting to look more closely at what their stocks are doing, because they know that part of the purpose of stocks is not just to create capital gains, but also to hedge against losses in purchasing power. And so, yeah, there's a growing awareness of that, which, as an economist, I like when people have greater awareness of economics. I would rather them acquire that as a result of curiosity rather than out of fear.
Desperation.
Yeah, right.
Yeah. Yeah. Um, it seems like um we're in a moment of real change. I
Yeah,
wanted to ask you, so how far along the path towards de-dollarization do you think we are, and what happens next? That's one question. We'll go on that from there.
sure. So for better or worse, and I would say probably for Americans, it's for the much better. De-dollarization is taking place very slowly, and that stands to reason, because the dollar is hugely entrenched in the economic in the global economic system. It's used for savings. It's used to get access to treasury bonds, which are still sort of the gold standard in government finance worldwide. It's used for different transactions. And the other thing is that as much as I criticize the Fed, and they deserve it, the Fed is still kind of the gold standard in the world. I mean, most other countries have higher average inflation than the U.S. does. Not all, but most. So de-dollarization is taking place very slowly. It's also something I think is reversible. What's not helping, though, are some of the things we've seen under the banner of what's been called the Mar-a-Lago Accord, which is part of the plan that Stephen Miran, who was formerly or maybe still now, the chairman of the Council of Economic Advisors, and has been recommended to fill one of the slots opening on the Fed, has put forth. And it's this plan that suggests doing things like replacing existing treasuries with 100-year treasuries, with weakening the dollar. If you weaken the dollar, American goods become cheaper overseas, foreign goods become more expensive in the US, but that speaks to inflation-like effects. So, all of that in associated with the Mar-a-Lago Accord and other things would accelerate de-dollarization, but it's still pretty slow, because the U.S. dollar has been the global reserve currency since after World War II, and somewhat astonishingly, if you look at history, it remained the global reserve currency after we abandoned the gold backing in 1971. So it takes a very long time for as entrenched a fixture as the dollar to be replaced or joined by another potential currency.
What portion of de-dollarization do you think is reversible, and how?
It would actually be very easy. What we would need to do is say, we're not going to tinker with the value of the dollar. We'll let the market determine that value.
Mhm.
We'll start to run smaller deficits. We'll cut our debt, that sort of thing. Just a little bit of fiscal sobriety would go a long way towards restoring the centrality of the dollar. And also, I think, however it's possible, it might be a threat that the U.S. government likes out there, but some measure of saying, maybe not we were wrong, but we will think twice in the future before we kick another government out of SWIFT, that sort of thing. Using the dollar as a weapon, some sort of agreement, or some sort of a representation that we won't do that in the future, would restore faith in using the dollar even among our enemies.
How realistic are any of those measures to be implemented?
Completely unrealistic.
Right. So it's
I
there.
think so. Yeah, yeah,
It's nice to know that there are potential things that could happen, but
right.
essentially it's unlikely that they will happen. And so we're on this path, and it's
It's
happening slowly,
very slowly.
although some things that are happening outside of the United States could potentially um, move even faster, right? With the BRICS
Yeah,
alliance and go ahead.
right. So there are a lot of alternatives available now that there weren't in the past. For example, crypto and stable coins. I mean,
Hmm.
those things could be used. I think what most nations want is they don't want to act, I don't think many of them want to replace the dollar so much as they want to have a place to go if their access to the dollar is either restricted or seems unwise,
Hmm.
right? So I mean, heavens forfend, we get in a war one day, we may see another country say, we're gonna fall back to using this, BRICS stable coin or this BRICS currency for the duration of this war or whatever, that sort of thing. But I mean, it still makes good sense for a lot of nations, even those that aren't very friendly with us, to use the dollar because accounting systems, conventions. I mean, when I was a trader, if I picked up the phone and I went to buy or sell oil, I wouldn't even have to say dollars. I would say 5 million or 2 million because it was just understood. The dollar is the lingua franca of the global economy. But I mean, it is slowly but surely happening. And I'll just add one more thing, and that is that a lot of nations, when we talk about, say, Brazil and India, they're at the threshold of achieving regional superpower status in some ways, at least economically. A lot of them find it a little undermining of their message of self actualization, by using the dollar. It seems like if you're going to be that kind of a power, why wouldn't the real or the rupee, be the currency that's used? So nations are looking for alternatives. They're still going to use the dollar for most of their purposes, but for the first time, we see a search going on for alternatives.
Right. So
Right?
back home, in, if the administration doesn't do the things that you suggest, then
They won't.
at which they won't.
Yeah.
So you sort of hinted at this before, that the Fed, for all its faults, is sort of backed into a corner. It doesn't have a lot of good moves left. So,
Right.
um, where does that lead us? Are we just kicking the can down the road and papering over things to make it seem like things are better than they are? What happens when we run out of road?
So fiscally, we are definitely kicking the can down the road. There's never been less appetite to restricting or shrinking deficits and knocking down the huge pile of debt. I mean, it was forecast in the year 2000 that we would reach this $37 trillion in debt in 2030, and we hit it this year. So I mean, things are going faster and faster. As for on the monetary side with the Fed, I mean, one thing that could happen, one thing that I would like to see, a lot of people who are, they're fiscally conservative or they're libertarians or whatever, they say end the Fed. Okay, I mean that's a nice idea. It would be very hard to do. I think a more near term solution would be to reform the Fed. The one thing we could do right now that would really make the Fed work more for the American people and sort of help out our withering dollar would be to limit the Fed to a single mandate. Right now, the Fed has a dual mandate. It's maximum employment and price stability. If they were limited to price stability, unemployment or employment, labor markets would take care of themselves. One of the reasons why you see unemployment is fluctuating prices or an inability to anticipate what the dollar will do. So, I mean, that's one thing that could be done in the short term. It would have to be done by Congress because the Federal Reserve is an agency that was set up by act of Congress. But I mean, if we did that, that would go a long way towards stabilizing the dollar, making the dollar even more competitive than a lot of international currencies that are kind of weak but potential replacements or stand-ins for the dollar in some measure. And yeah, I mean that's certainly fiscally, the ball is in motion, but monetarily there are some ways that we could fix things in the short to medium term.
Do you think reform is even possible? I mean, we're seeing a lot of shakeups. You've mentioned some of the personnel changes, but
Yeah.
do you think that any reform or, do you think any of it will make any difference?
So, I use as my guide to that question the whole issue we saw a few years back about the question of auditing the Fed. I
Hmm.
mean, what that actually means is uncertain. Does it mean an actual audit? Does it mean looking at the books? Does it mean interviewing members? We're not really sure. But when we saw a move put forth to audit the Fed, both sides of the aisle sort of revolted. You saw people like Elizabeth Warren who didn't want it. You saw people who were Republicans who didn't want it. And it's a curious thing because I think one thing that makes the Fed unique in terms of the U.S. economy is if you want to enact fiscal stimulus, which means you want the bonds or whatever, or stimulus checks and all that stuff, you have to go through Congress. And that takes months and months. It takes a lot of political horse trading. A lot of factors have to be built in. It takes a long time, and also fiscal stimulus is a very short term. I'm sorry, is a very long term economic influencer. It takes months for fiscal stimulus to work its way through the economy. The Fed can do something in a day. Right now, the Fed this afternoon could say we're going to lower rates 50 basis points, and they could immediately change the economy. So the Fed is kind of it's a very desirable tool for politicians to have, even though they're nominally independent and they try not to be politically influenced. They represent a sort of a sacred cow that I don't think a lot of politicians want to mess with. And so for that reason, I think that limiting them or making the changes that go towards a single, for example, what I'm saying, a single mandate of price stability, I'm not sure there's a lot of political will to do that. I think they want the Fed to have to be nominally independent, but the ability to lean on them and even try to force them to do what they'd like if they could. So from that perspective, I also think that while it's more possible than fiscal reform, it's still a quite a ways away, unfortunately.
The beginning of this year, all eyes were on Doge, and
Yeah.
now we're not really seeing it much in the
Yep.
headlines. What's your take on what happened in the first few months of the year? Or is there going to be any impact?
There won't be much, and the reason is because Doge was restricted from touching those areas that typically are the biggest contributors to our deficits: Medicare, Medicaid, Social Security, military spending, and of course, the other factor is the debt on the national, the interest on the national debt, which is not really in Doge's purview. But when you tell a cost-cutting entity like that they can't touch certain areas, and those are the areas where most of the fiscal expansion is coming from, they're kind of limited. I mean, I think there was a good show in going after USAID and that sort of thing, but I mean, while all savings are good and they're good for taxpayers, it was immediately politicized, and they couldn't touch the areas where they would have had the greatest influence. So hugely missed opportunity, but of course they were restricted to the areas that the administration allowed them to go after.
Did the cuts that Doge did make get reflected in those BLS numbers that you analyzed?
Um, Not yet. They probably will. There was some of that. I mean, I think what we saw is more on a state level, some of those influences, because some of the government spending winds up going down to states and cutting back on that level. But we've actually seen government jobs increasing most counterintuitively recently. So no, I wouldn't say that. I mean, Doge was I think it was a worthy effort. I was pretty excited to see what they would come up with, but it was mostly disappointing because they were restricted in the ways they were, and they immediately, as one would expect these days, they immediately became uber politicized, and so
Right.
anything they did was viewed as a threat to one side or a boon to the other.
So as we come to a close, what should people be bracing for? What's one thing that you think most people don't understand about where the economy is headed right now?
I not just because it's the thing I talk about and look at every day. I wonder when the tariffs are in place full force, if they will immediately have a negative influence and be withdrawn. And of course, they won't be withdrawn with a statement of either culpability or apology. It'll be, oh, we reached our objectives or whatever, and we're gonna we're gonna make this we're gonna lift these tariffs. I
Mission
wonder.
accomplished.
Yeah, exactly. I wonder if when those tariffs will hit, we will immediately see a response in the economy. I've been doing this for too long to predict a recession or whatever, but I mean we already saw in the last GDP number a real decline from the first to the second quarter in private domestic investment, and so I think that a lot of businesses are really sort of leaning back and waiting for this. Like I said, Walmart's earnings were instructive about what big companies will do. Smaller companies are very worried about it because they don't have the kind of margins that they can eat into like the big companies do. So
Mhm.
all eyes pretty much right now on tariffs. And also, if the Fed lowers rates to respond to the softness we see in the job market, what will inflation do? So I mean that's another factor there. And after 3 years of pretty withering inflation, if we see it surge back up, and not to 9% or 10%, but even just to say 4% or 4.5%, it's going to be very, very hard for consumers, in which we're already seeing a lot of arrears in certain forms of debt, credit card losses are rising, that sort of thing. So I think tariffs are going to be a pivotal factor in the next 6 to 12 months.
So, do you have any sort of practical advice for people as they prepare for what is yet to come in the next 6 months?
I mean, the general thing that anybody would tell them, not something that takes some, professional economists to tell them. I mean, try not to add much to debt, pay down your debt. Try to focus on the essentials rather than discretionary and luxury items, that sort of thing. I mean, you have to live your life, but I mean, a little bit of caution right now, I think, is warranted because it's been 80 years, 90 years since we've had tariffs as high as we are told that they will be going. It's hard to imagine. I mean, a lot is going to pivot on what happens with China, and China and the U.S. are very closely tied together. Much though we don't want to, much though political figures don't want to represent it, and for that reason, what happens with tariff is what happens with tariffs on China rather is what's going to be sort of the pilot fish for the rest of the economy. So I'll be watching that when this next 90-day period is up.
Mhm. Do you personally see any big opportunities right now?
For consumers or
Yeah, either as an investor or as a consumer.
well, I mean, I always have to say I'm not a financial advisor or a
Right,
financial
of
planner,
course.
and always ask your advisor first. I mean, while there will be a breather, I mean, I think that in a period where there's so much uncertainty and where there's so many forces pushing prices up, whether they're tariffs or whether it's inflation, I mean, gold and silver are pretty high right now. Crypto is, of course, all over the place. But I mean, thinking of alternatives to stocks is probably not the unwisest thing. But as always, check with somebody who knows your financial circumstances better than I do.
Of course. Absolutely. Yeah. Do
Yeah.
not take this as financial advice,
Right.
just a
Right.
conversation.
Exactly.
But we so appreciate it. You do always do such a great job of cutting through the jargon and spotlighting the real forces that are shaping our lives. So we really appreciate you coming back on. Remind people how they can find you and read your work.
Sure. So I write in the daily economy section of AIER. That's the American Institute for Economic Research, AIR.org. And I also I'm on Twitter as at Peter underscore C underscore Earle, EARLE. And you can see me on Newsmax, CNBC, Bloomberg, those channels occasionally as well.
Thank you so much. We're happy to have you on Collapse Life as well, and so appreciate it.
It was great to be back. Talk to you soon.
Talk to you soon. Thank you so much. Folks, if you subscribe, that really helps us asking the hard questions and bringing on smart voices like Peter's. So please hit that subscribe button now, give us a like, and share this video with someone you know who could really use this information. If you want more, head over to collapselife.com to check out our articles and sign up for our newsletter. And if you like what we're doing, think about a subscription for just $8 a month. You'll be supporting truly independent journalism, and every penny makes a difference. You can also support us without a monthly commitment by swinging over to our Buy Me a Coffee page. You decide how much caffeine you think we need. Just know that every drop is truly appreciated. We'll see you back here next week. And until then, just remember, keep your chin up. It's only collapse. See you soon.